Welcome to Business with Louis, the podcast where we explore the world of business and entrepreneurship in a way that's both informative and inspiring. Today, we're going to dive into one of the most significant economic events of the 21st century, the 2008 financial crisis explained. The 2008 financial crisis was a global phenomenon that had far-reaching consequences for individuals, businesses, and governments alike. At its core, it was a complex interplay of factors including subprime lending, securitization, deregulation, and excessive risk-taking by financial institutions. But what does this mean in straightforward terms? Simply put, the crisis occurred because many banks and other financial institutions gave loans to people who couldn't afford them, then packaged these risky loans into securities that were sold around the world. When the housing market began to decline, the value of these securities plummeted, leaving banks with huge losses and insufficient capital to operate. This concept is crucial in the world of business and entrepreneurship because it highlights the importance of responsible risk management, regulatory oversight, and ethical decision-making. The crisis led to widespread job losses, home foreclosures, and a significant decline in economic output. It also prompted a major overhaul of financial regulations, including the Dodd-Frank Act in the United States, aimed at preventing similar crises in the future. One key concept is the idea of moral hazard, which occurs when individuals or institutions take on more risk than they would normally because they believe someone else will bear the consequences of their actions. In the lead-up to the crisis, many financial institutions engaged in risky behavior such as subprime lending and excessive leverage because they believed that governments or other entities would bail them out if things went wrong. Influential thinkers like economist Joseph Stiglitz have argued that the crisis was also fueled by a flawed economic ideology that emphasized deregulation and free market fundamentalism. This led to a lack of oversight and regulation, allowing financial institutions to engage in reckless behavior with impunity. The evolution of our understanding of the 2008 financial crisis has been significant, with many experts now recognizing the need for stronger regulations and more robust safety nets to prevent similar crises. Lehman's collapse was a pivotal moment in the crisis, as it led to a freeze in credit markets and a sharp decline in investor confidence. On the other hand, companies like Goldman Sachs and JPMorgan Chase were able to navigate the crisis relatively unscathed, thanks to their more cautious approach to risk and their ability to adapt quickly to changing market conditions. Buffett's firm, Berkshire Hathaway, invested $5 billion in Goldman Sachs in September 2008, providing a much-needed capital injection that helped stabilize the bank. This move not only generated significant profits for Berkshire Hathaway, but also demonstrated the importance of long-term thinking and strategic risk-taking in times of crisis. So, how can you apply the lessons of the 2008 financial crisis to your own business or career? First, it's essential to understand the importance of risk management and diversification. Don't put all your eggs in one basket, as the saying goes. This means spreading your investments across different asset classes, industries, and geographies to minimize exposure to any one particular risk. Second, stay informed about market trends and economic indicators, but avoid getting caught up in the noise. Focus on fundamentals rather than speculation. Third, always keep a long-term perspective, just like Warren Buffett. This means prioritizing sustainable growth and profitability over short-term gains, and being willing to make tough decisions to ensure the long-term health of your business. Finally, be prepared to adapt quickly to changing market conditions, whether it's a crisis or an opportunity. This requires staying agile, innovating continuously, and fostering a culture of resilience within your organization. Research findings have also highlighted the importance of strong corporate governance and ethical leadership in preventing similar crises. A study by the Harvard Business Review found that companies with robust governance structures and a strong emphasis on ethics were less likely to engage in risky behavior and more likely to survive the crisis intact. Another study by the International Monetary Fund (IMF) found that countries with stronger regulatory frameworks and more effective oversight mechanisms were better able to weather the crisis and recover more quickly. In conclusion, the 2008 financial crisis was a complex and multifaceted event that offers valuable lessons for entrepreneurs, investors, and policymakers alike. By understanding the underlying principles and applying them to our own endeavors, we can build more resilient businesses, make smarter financial decisions, and contribute to a more stable and prosperous economy. Thanks for tuning in to this episode of Business with Louis. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.